how you can make money in the stock market. So the most important tip that I will leave you with is that if you want to make money in the stock market, then you should not be dependent on the stock market. Now, what do I mean by that? Hello everyone, welcome to today's video. So today I'm going to teach you how to get rich slow. This is super counterintuitive because you might have heard a lot of people who would make tall claims that, hey, come buy our course and you will become a crorepati in 6 months. Come buy our course and we will help you make 10 crores in 1 year. So none of that clickbait. I'm actually going to share my real strategy of how I got started in the stock market, what are some of the mistakes that I made, and what are some of the key lessons that I learned along the way. Hopefully through this discussion, you would understand the power of becoming rich slowly but sustainably. So let's get this video started. And just a humble request that if you like this video, please press the like button. I would urge you again that please press the like button. It would indicate to me that you appreciate this type of content and I would continue to shoot such videos. So when I started my first job, I used to make 20,000 rupees and I used to live in Delhi. So I was working at Ministry of Rural Development and the salary was not high. So that entire money used to go in rent, food, transportation. So I had very little money left in terms of making investment. But on the sideline, so I started taking coachings for GMAT. I had a 770 on the GMAT, so I had a good score. So I started taking some private classes over the weekend. So through that, I started making money in the range of 30 to 60,000 every month. And that money became my investment amount that I used to invest. So initially, my strategy was that, hey, I will just get the money and I will put it in a bank savings account. And that was it. So I was making a little bit of money there and I used to earn 3 to 4% interest. And that was it. Then my mom got me interested in investing, and what she told me was that, hey, why don't you get some FD done, fixed deposit done, because she also used to invest a lot of money in FDs. So I started making a little bit of FD deposits and that used to give me around 5 to 7% return on yearly basis. Now I quickly realized that, this is like a bad investment. Even my mom quickly realized that, this is not probably the right method for me, who is someone who is young, to invest all their money in an FD. And then she probed me that, hey, why don't you go and invest in SIPs and do an SIP in mutual funds. So I thought that, okay, great, everyone is talking about SIPs. So let me just go figure out how to do SIPs. And then I started doing SIPs. So SIPs are systematic investment plans. And through this, your money gets invested in mutual funds. So I had no clue how to do investments through SIPs. So there was one of my mom's associate and he was a mutual fund agent. So he used to come to my house. He used to show me all the valuable and lucrative returns that people used to make through SIPs by investing in mutual funds, and he convinced me that, SIPs are the way to go, and I started doing SIPs. So I did that for 6 months, and the way I used to do SIPs was very silly. That what I used to do was that I used to look at historic returns. That, for example, XYZ mutual fund gave 15% return historically. So I imagined that it would continue to do it. So I used to do SIPs on those type of assets that were giving 15%, 20% hypothetical returns. And imagine what? That I never used to get those kind of returns by investing in SIPs that I used to do. So soon I got disillusioned that I realized that, I'm looking at the returns of these excellent mutual funds. They are historically giving 15-20%, but when I invest, I barely get like 5 or 7% return in an yearly basis. When I used to ask my mutual fund agent that, why did this happen? And he used to tell me that, Akshat, the market is down. That's probably why. Every time the market was down. And I continued doing this for approximately a year. And I soon realized that, boss, there is some game that is wrong here. So I realized 2 important lessons. Number 1, it's very important to understand the concept of investing. If you don't invest, you will lose out money. For example, initially, in the initial days of my career, I was putting money in savings account and FDs and I was losing money because of a concept called as inflation. So I will link the video somewhere here. Please go and watch it. You will understand that if you're just depositing your money in FDs or savings account, you're actually losing money on yearly basis because India is a high inflation market. So that was the first key lesson. The second key lesson that I learned was that, hey, never trust others with your money. That is not something that you should do. You should actually take active role in terms of the investments that you're making. So this brings us to the second part of my story. Now, after 1.5, 2 years, I started realizing that, I've learned 2 important lessons that I need to invest and I don't need to trust others with my money. I need to figure out a way to make investments myself. So I went and explored the route of making direct investments in equity market. But the moment I started analyzing the market, I realized that, this is like super complex. There are so many things to consider. There are so many companies to consider and I just don't have the time along with a full-time job to actually trade in stocks. So what I did was that I did the next best thing, that I started investing in mutual funds myself rather than going through a mutual fund agent. I directly started investing in mutual funds. And almost all my investments at that stage were being made in actively traded mutual funds. Now, what do I mean by actively traded mutual funds? These mutual funds actually have a mutual fund manager, a team that runs an office, and they literally trade on that mutual fund on day-to-day basis. Right? So essentially I am investing in their mutual fund, and this mutual fund manager will have a big team, and this team will pay itself a commission from the money that I am paying them, and they will trade the money that I am giving, right, in stocks. That is how active mutual funds operate, that they charge a higher commission, right? At the time when I used to make this investment, I did not realize the difference between actively traded mutual funds and passively traded mutual funds. So I imagined that if I am giving my money to an expert, he or she will manage my money wonderfully well and will generate like massive return, and I'll become rich, right? Guess what? None of that happened. So what ended up happening was that I ended up making 6-7% return for another year. And again, I get bogged down by the entire scenario, and I started investigating that, it just doesn't make any sense, right? When I myself was investing my money in FDs, I was making 5-6%. And some of my actively traded mutual funds are giving me only 7-8% return. Why am I doing all this just to make 2% additional return? It was madness, right? This led me to ask myself a simple question, that why these mutual fund managers are able to generate only 8% returns. It just did not make any sense to me. And that is when I started analyzing the markets a little bit more. I started investing in equities myself, and I very quickly realized that a couple of things were happening. Number one, that these actively traded mutual funds were charging a lot of commissions. So I used to lose out on a lot of commissions. That was problem number one. Problem number two, if you actually analyze the FII and DII data, so FIIs are foreign institutional investors and DIIs are domestic institutional investors, which are mostly these big mutual fund managers, which are running the actively managed mutual funds. So this is the difference between FII and DII, right? Now what used to happen was that the market mechanism was such that on some days, when FIIs used to buy, DIIs used to sell. Right? And on some days, when DIIs used to buy, FIIs used to sell. Now, this made no sense, right? This made no sense in the sense that why would big foreign institutional investors would be buying the same stocks, and DIIs, why would they be selling the same stock? It made no sense to me back in the day, but now it makes a lot of sense that FIIs and DIIs are actually working in collaboration. DIIs will hardly ever give you more than 10 to 12 returns consistently over a long year period. Now, earlier I explained you the concept of actively managed mutual fund, where the mutual fund managers are charging a lot of commissions and retail investors like me were losing a lot of money. So I diverted my investments to passively managed mutual funds. This brings me to the third part of the story, where I was making a lot of investments in passively managed mutual funds. So let's look at Nifty 50, right? So passively managed mutual funds essentially means that, hey, there is a mutual fund manager, but that he or she is just mirroring the market. What they're doing is that, for example, that if we are at this spot in the market, and if the market is trading at 15,600, right? And if I place my order of buying the mutual fund at 15,600, then at this stage, the mutual fund manager will buy and mirror this index. He or she will buy exactly the Nifty 50 stocks in that same proportion that indicates this particular mark. That's it, right? So resultantly, the commissions that are charged on passively managed mutual funds are much less, right? They are much less compared to actively traded mutual funds. Just a very quick fun fact. Now, I would want you to comment on this, that do you think that passively managed mutual funds make more return in the long term, or actively managed mutual funds make more return? Read my answer in the comments. I will hide my answer somewhere in the comment, but I would want you to do this exercise. What is the 20-year average return for actively managed mutual funds versus passively managed mutual funds? You do this exercise and you will understand that why was I investing in passively managed mutual funds. So coming back to the topic, so I started investing in passively managed mutual funds, but there were two problems that I started facing. Number one, that whenever the market used to go up, for example, if you take a look at this 2017 period, the market was constantly going up, right? It was going up. Right? Then I used to think that, hey, you know what, market is actually going up and it is going consistently up, so maybe it will come down and then I will do my SIP, or I will actually invest some lump sum amount, right? So I used to miss out in terms of making investments in a regular cycle. That's one. Second problem that I faced was that earlier I used to do consistent investments, right? For example, if you take a look at this entire period, right, from April 2010 to 2014, market hardly moved much, right, in this period. right? It was essentially trading in that same range. So despite me doing SIPs, I was not getting any returns, right? This was the second problem. Now the third problem was that whenever market used to go up, and if I was holding this particular index, then I used to get this temptation that, hey, let me sell it. On some occasions I sold it also, but then came the problem that, hey, you know what, market is just not going down. So how will I reinvest? Right? Let me explain this point further. For example, let's imagine that I was holding the index from here. It was trading at, let's say, imagine 5,000 range, right? Then here it became, let's say, 10,000, right? Now I sold my index completely at 10,000 levels and I made money. And now let's say that if I have 10 lakh rupees sitting in my bank account, what am I supposed to do with it? I can't reinvest. That is the primary problem that I faced in terms of making investment in passive mutual funds. Passive mutual funds are great, but only if you want to just hold it, right? And you don't need to trade it. You don't need to invest it and grow that money on consistent basis. So it's good for holding, but again, it can A, make you very frustrated if the market is not moving. Number two, if it grows, you might stop your SIP, imagining that, you know what, market has just done a too much run up. Number three, even if you sell it, you would have reinvestment risk. So these were some of the problems that I faced in terms of managing my passively managed mutual funds. So then I finally realized that, you know what, enough is enough. I actually need to take care of my investment because this is something that will impact my whole life. I actually need to start learning how to invest. So I read a lot of books. I analyzed a lot of balance sheet. I read about different companies. I analyzed and worked from my previous experience of investing in mutual funds. Combining all this, I started getting a sense that, hey, you know what, there's a first step to equity investor. You need to start investing in blue chip companies, right? You need to start investing in blue chip companies. So what I simply did was that I identified 20 best stocks in India, just 20 best stocks, and I started investing my money in those 20 stocks. That's it, right? These were top companies like HDFC Bank, Reliance, Maruti Suzuki, Tata's. So these are the companies for which I bought stocks. But since I was a novice investor, I actually used to lose money on some of these trades. Now you might ask that, hey Akshat, why did that used to happen? You were investing in such blue chip companies. Why did you lose money? So let me show this to you. So I remember buying Maruti Suzuki stock. So Maruti was a growing company. It was giving consistent return. As you can see from this entire graph that, hey, Maruti was on an uptrend. And I bought that stock because there was a lot of positive news about Maruti, how it plans on building new distribution centers, how it plans to improve distribution, how India-centric focus is going to come up. So I bought a lot of shares for Maruti, right? Somewhere here, right? At around 4,500 levels. Now then what happened was that the Maruti share actually went down and it went down to 3,400 and I panicked and I sold my entire lot and took a huge loss. Right? I'm telling you because I was a novice investor back then. I did not understand investment fundamentally and I genuinely felt that, you know what, there is something wrong with the Maruti stock. Let me just sell it out and go out, right? I did not have tools like analyzing default probability or quality checks, etc. I did not use these features. I just literally traded on news and I took a huge loss and went away on a blue chip company, right? And I can show you multiple examples of these blue chip companies where I've lost a lot of money because I literally traded on news. When good news used to come, I used to go and buy stocks. When bad news used to come, I used to sell my stocks. So as a result, because of this news-based trading, I lost a lot of money even on blue chip companies despite me buying fundamentally good stocks. So this brings me to the final part of my stock market journey, which started somewhere around 2015. And since 2015, I have been making consistent return ranging between 20% to 40% in stock markets and have been investing huge amount of money in that. So what changed for me? First and foremost, the first key thing that changed for me was that I actually learned about investing. I learned from my mistakes that I had made up until this point. I learned from the fact that, you know what, long-term investing is not always good. You actually need to trade to make money. So I started engaging in different styles of investing, right? From swing trading to long-term investing to short-term trading, intraday, whatever. You name it, I have learned it from that angle. So I started investing a lot of time learning. So I spent good 2 years learning about stock trading, stock investing and different styles of investing. So that really helped me amp up my knowledge about stock markets and I started making investments in a more convincing way. There were times when the stock used to tank and I used to stay calm because I knew that I had learned the fundamental research. Second, I realized the power of fundamental analysis and analyzing certain techniques like momentum strategy, buying low, selling high, what is bull run, what is bear run, started studying economics, interrelating all those concepts to make money in the stock market. Yesterday I had posted a video on some strategies on how I buy low and sell high. I will link that video somewhere here. Please go and watch it. You will understand how I do fundamental analysis more holistically. But just to very quickly show you the concept so that you don't miss it. So let me just quickly share my computer screen and let us look at what do I mean by buying low and selling high. So let's look at HDFC Bank Limited. And here see, this is a fundamentally very sound stock, and you can check that hey, the default probability is really low. It has good quality checks. The growth rate is very high. You can actually check the forecast, right? That hey, it has like high probability of growth. All these fundamental analysis can be done very, very quickly. Now the important point to notice is that retail investors actually lose money because they buy here and they sell here, right? The opposite should be the case, that they should actually be buying here, right? They should be buying here and they should be selling here, right? If you understand concepts like support, resistance, MACD, all these technical parameters, if you understand fundamental analysis, it can actually change your life. Let me explain this point further by giving you an example of Ray Dalio's strategy. So Ray Dalio simply says that if a fundamentally strong company is posting its highest ever profits, if a fundamentally strong company is posting its highest ever profits and it is trading below its highest ever price, then it's a good time to buy, right? So we can actually check that in HDFC Bank's case. So let us just quickly take a look at the financials here. So here you can see that from year on year, since 2018 to 2021, the profits or net income has actually grown for HDFC. So is it posting its highest ever profits? The answer is yes. And if you actually go and take a look at the price chart for HDFC Bank, this is what you will find. Now, is it trading now? Now, today we are sitting at 18th June. Is it trading at its highest ever price? The answer is no. It is trading at 14.18 and its highest ever price was 16.26, right? So you have approximately 140, 150 rupees that you can easily make from this stock, even sitting today. Such a simple strategy. So learning such strategies, understanding the viewpoint of different investors, implementing that into my own strategy style, actually ended up helping me make a lot of money in the stock market. So this brings me to the sixth and final point about stock markets and how you can make money in the stock market. So the most important tip that I will leave you with is that if you want to make money in the stock market, then you should not be dependent on the stock market. Now, what do I mean by that? What I simply mean by that is, so I've seen a lot of my friends and associates, what they do is that they get so excited by the journey of stock market that they take loans and start pouring that money in the stock market. Never do that. Always have a source of income that gives you holding power in the stock markets. For example, there have been times when I was having 30% loss on a stock, but I was able to hold it because I was able to make money from other sources. So I was able to hold that stock. I had no necessity of selling that stock, and eventually that stock turned around and it started giving me massive profits. So the point that I want to leave you with is very simple, that number one, please don't take loans to trade in stock market. Number two, please do your own due diligence. Number three, have multiple sources of income outside the stock market that would allow you to make massive bets. You might have seen me making massive amount of bets. I have shown you my portfolio before that I make really large bets on a bunch of stock. The reason why I'm able to do that is because I have built other sources of income. So I feel that if a corona-like pandemic again happens and the stock market tanks, I would be making money elsewhere from that perspective. So it gives me the confidence of playing a little bit risky in the stock market and analyzing and being confident in the moves that I'm making. So that is the message that I will leave you with. Please give it a thumbs up and a like. That would mean a lot to me. It would indicate to me that you appreciate this type of content and I would continue to shoot such videos.